We're jumping straight into Adobe today. Everyone is watching the price action, but the real story is the massive disconnect between their stock price hitting multi-year lows and the actual cash they're generating from AI.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
If you appreciate us cutting through the noise to get to the money, do us a favor, subscribe, and hit that like button. It helps us keep simplifying the market for you. Now let's look at the calendar. It is late January 2026.
Right. And the tech world is spinning fast, and Adobe is, well, it's sitting in a very strange position.
Strange is putting it mildly. It's like we're looking at two completely different companies depending on what you look at.
Totally. On one hand, you have the absolute giant, the behemoth of creative software. If you've ever edited a photo, signed a PDF,
Or designed a logo, yeah.
you've probably used their tools. Photoshop, Acrobat, Illustrator. These aren't just products, they're verbs. They are the industry standard. You don't say edit an image.
You say Photoshop it.
You say Photoshop it. The brand is that dominant.
Right, that brand dominance is undeniable. But despite that, there's this incredible tension. The stock has taken a serious beating recently. It's testing major support levels, trading at lows we haven't seen in years.
If you just look at the price chart, you'd think the company was in a death spiral.
Exactly. But then you flip open the financial statements, and the underlying business just posted record revenue.
And that's the mystery we're going to try and unravel today. How can a company be doing so well on paper? Literally breaking its own records. Yet the market is treating it like it's radioactive.
It feels like a battle between narrative and numbers. The narrative is just pure fear.
Fear of AI.
Specifically, the fear that AI is going to replace human creativity and, by extension, Adobe. But the numbers tell a story of a financial fortress that's actually, getting stronger.
Well, let's stop talking around it and actually dig into those numbers. Because usually when a stock drops this hard, I expect to see the company bleeding cash or hemorrhaging customers. But when I look at what they just reported for Q4 of fiscal year 2025, that is not what I see at all.
No, it's a cash machine. Revenue came in at $6.19 billion for the quarter. That beat estimates. But I love to look past the top line.
Revenue is vanity, cash is sanity.
Always. And the metric that really matters here is free cash flow. They are generating nearly $10 billion in annual free cash flow.
Okay, let's just pause there for a second. $10 billion. That is a staggering amount of liquidity. That isn't accounting magic. That is cold, hard cash hitting the bank account.
Precisely. And that gives them so many options. That's capital they can use to buy back their own stock, which supports the share price, to acquire other companies, or to invest heavily in their own AI models without needing to borrow a dime.
They're self-funding their own evolution.
They are. And this is where it gets really interesting for the value hunters out there. Because the stock price has dropped so much, but the earnings are so steady, the valuation has compressed a lot. We are looking at a trailing PE, a price-to-earnings ratio of around 17.7 times.
Let's put that in perspective for a second. The average PE for the S&P 500 is often higher than that.
Way higher. For a massive tech monopoly with 30% profit margins to be trading at 17 times earnings, that is historically cheap. Usually for a company this safe and this profitable, you pay a premium.
That's the thing, though. The market isn't pricing in safety right now. It's pricing in obsolescence. The market thinks this is a value trap, that it looks cheap because the business is about to fall off a cliff.
So investors are looking at 17x earnings and saying, yeah, but what if those earnings go to zero in 5 years because robots do all the design work?
That's the bear case in a nutshell.
Yeah.
But I think that completely ignores the moat. And I love talking about moats.
Oh, yeah. For anyone new to the term, it's basically how hard it is to attack the company's castle. And Adobe's castle walls are incredibly high.
They're high because of switching costs. This is something people often underestimate. If you are a professional video editor, you haven't just bought a piece of software.
No.
You've invested thousands of hours mastering Premiere Pro. Your entire workflow, your keyboard shortcuts, your team's file formats, your muscle memory. It's all Adobe.
It's not like switching from one brand of toothpaste to another.
Not at all. You don't just switch to a new tool because it's $5 cheaper or because some new AI feature looks cool. Switching would cripple your productivity. You have deadlines to meet. You can't just spend 3 weeks learning a new interface to save a few bucks.
And we have a great stat to back that up. Look at the Sundance Film Festival. 85% of filmmakers there use Adobe tools. These are the pros.
The top of the top.
These are the people whose careers depend on the software working perfectly every single time. They aren't leaving.
And it's not just the high-end pros. Monthly active users are up more than 15% across their key platforms: Acrobat, Creative Cloud, Express.
So despite the whole narrative that everyone is leaving for cheaper tools, the user base is actually expanding. More people are coming into the ecosystem, not leaving it.
But we have to address the elephant in the room. The reason the stock is down is AI. The fear is that AI will make Adobe obsolete.
But I want to flip that. I actually think AI is their secret weapon, specifically because of how they're doing it.
You're talking about commercial safety. This is the critical differentiator that I don't think retail investors fully appreciate yet. It sounds like boring legal jargon, but it's actually the product's killer feature.
Right. Everyone is playing around with these open AI models generating crazy images.
Yeah.
But if you are a massive corporation, let's say Coca-Cola or Nike, you cannot use an image generated by a random AI model in a global ad campaign.
Why not? The images look fantastic.
Because of the legal risk. You could get sued for copyright infringement if that AI was trained on stolen data or artists' work without their permission. A CFO at a Fortune 500 company is just not going to take that risk.
They're not going to bet $1 billion brand on a shaky copyright claim.
Never. And that is exactly where Adobe Firefly comes in. Adobe trained their AI model, Firefly, on their own library of Adobe stock images. They own the rights to the data.
So they can tell their enterprise clients, if you use our AI, it is commercially safe. We will even indemnify you.
That word indemnify is the key. It means if you get sued, Adobe pays the legal bills. It's essentially insurance for your creativity.
And that's why the big companies are sticking with Adobe. They aren't just buying software, they're buying legal safety. It's a massive competitive advantage against some startup that just scraped the internet to build their model.
It creates a bifurcated market. Hobbyists and small creators might use the wild open tools.
But corporate America, the people with the big budgets, will use the safe tool. And Adobe owns the safe tool.
And they are just layering more and more value on top of that. We have to talk about the strategic moves they're making to broaden that ecosystem. Specifically, the acquisition of SEMrush.
Oh, this was a big one. They spent, what, $1.9 billion to pick up SEMrush? For those who don't know, SEMrush is a huge player in SEO and marketing data.
At first glance, people scratch their heads. Why is a design company buying an SEO data company? But it's a brilliant synergy when you think about it. Before this, Adobe helped you create the content.
And SEMrush helps you know what content to create to get traffic in the first place.
Exactly. Think about the workflow. Before, a marketing manager would go to SEMrush, find out that vintage sneakers is a trending keyword, then send an email to a designer saying, hey, make a banner for vintage sneakers. Then the designer opens Photoshop.
Right, two completely separate silos.
Now imagine that data is right inside the Adobe tool. You're in Adobe Express and it tells you, hey, you use the word vintage and make this background blue, your click-through rate will go up by 20%.
So you're saying they are moving upstream in the process?
Precisely. They're giving creators the data to justify their designs.
Right.
It's not just make a pretty picture. It's make this specific picture because the data says it will convert customers. That makes the software even stickier. It integrates the workflow from idea to execution.
So let's look at the scoreboard so far. We have a cash machine generating $10 million, a 17x PE, which is, objectively cheap, a massive moat with the pros, and a smart AI strategy with SEMrush. It sounds like a slam dunk.
It really does sound like one. But the stock is at multi-year lows. So we're missing something. We have to be fair here. Why is the market so scared?
Looking at the flip side, there is a very real reason the stock is down so much. We have to look at the bear case because the risks are real and the market isn't stupid.
Let's start with the growth numbers. They are good, but are they Adobe good? I mean, the guidance for fiscal year 2026 is for around 9.5% revenue growth.
And that's the sticking point for Wall Street. For a very long time, investors were used to 15%, even 20% growth, like clockwork. That's why they paid a premium for the stock.
So when you see that engine slowing down to single digits, the multiple you're willing to pay just compresses.
The market is basically saying, maybe this isn't a high-growth tech stock anymore. Maybe it's just a mature utility, like a power company. And utilities don't get 30x PE ratios.
Exactly. If you grow like a utility, you get priced like a utility. And then there's the competition. We mentioned the pros are sticking with Adobe, but what about everyone else?
What about the students, the social media managers, the small business owners? They're flocking to Canva.
Canva is the biggest thorn in Adobe's side right now. They have, 240 million users? They're just eating the low end of the market.
Right. If you just need to make a quick flyer for a bake sale or an Instagram post, Photoshop is overkill. It's too hard and too expensive. Canva is easy. and often free.
It's the classic disruption from below theory. Canva started as a toy, and now it's getting better and better. And sure, Adobe has Express to compete, but Canva has the mind share for non-professionals.
And the risk is, once those students grow up, will they graduate to Photoshop? Or will they just stay with Canva as Canva adds more professional features? That's the billion-dollar question.
But there is also disruption from, I guess, from the side. Now, I'm talking about generative AI completely changing the workflow. Tools like Midjourney, OpenAI Sora, Google Gemini.
This is the existential threat argument. If you can just type a text prompt into a box and get a high-definition video, which Sora can do, you still need complex software like Premiere Pro.
Do you need to learn how to color grade and edit timelines if an AI could do it in seconds?
That's the core of the AI bubble fear, the idea that AI democratizes creativity so much that nobody needs to pay for these expensive subscriptions anymore. Why pay Adobe $60 a month when a free bot does 90% of the work?
And the market is voting with its feet on this one. We have seen some institutional hesitancy. Not everyone is buying this dip.
No. Look at wealth enhancement. They trimmed their stake by nearly 39%. That is a significant exit. It tells you that some of the smart money is looking at this and saying, you know what? I don't like the risk profile right now. I'd rather be somewhere else.
And on top of all of that, we can't ignore the regulatory headache. The FTC lawsuit is still hanging over them regarding their subscription cancellation policies.
It just creates uncertainty, and markets hate uncertainty. It's a lingering distraction that definitely scares off some of the more conservative capital.
So we have a very clear battleground: value and cash flow on one side, slowing growth and AI disruption on the other. If you're listening to this and trying to figure out where the stock goes next, what should you be watching?
Well, we had some very specific triggers coming up in the next few months. This isn't a wait and see for 5 years kind of situation. We are going to get answers pretty soon.
First up, earnings. Q1 of fiscal year 2026 is coming up in late March.
Yeah.
And I am looking for one specific number.
The AI revenue.
Exactly. I want to see AI-related revenue cross the $250 million mark.
That's the magic number. Why that specifically?
Because if they hit that, it proves that monetization is accelerating. It proves that Firefly isn't just a cool feature people are using for free. It proves that enterprises are actually paying extra for it. If that number is light, the bear case gets a lot stronger.
Then, shortly after earnings, we have the big show. Mark your calendars for April 19th, 2026, the Adobe Summit in Las Vegas.
Right, this is their developer conference, but for investors, it's a huge catalyst event. We need to watch for the Experience Maker Awards and, more importantly, the new product demos.
This is where they typically announce new partnerships.
Yeah.
They already have deals with AWS, Google, and Runway. I'd be looking for deeper integrations there.
Totally. If they come out on stage and show that Firefly is integrated directly into the workflow of another massive tech giant, that could change the sentiment overnight. It moves them from being a standalone tool to being an infrastructure layer.
And from a technical perspective, just watching the price action right now is critical. As we said, the stock is testing multi-year lows.
It's sitting right on support. For the non-traders, that just means it's at a price floor where buyers have usually stepped in. If it holds this level, analysts are seeing upside targets ranging from $402 all the way up to $450. That's a lot of upside from here.
But if it breaks lower, well, that is a very dangerous signal. It would mean the market has decided to believe the AI disruption thesis over the AI tool thesis. It would signal a real lack of confidence that all that cash flow can actually protect them.
So let's bring it all together. What is the verdict here?
Look, here's the summary. You have a highly profitable cash machine. It's trading at a discount 17 times earnings because people are scared. But if you look at the actual usage, Acrobat Web is up 30%. Express Premium is up 70%. People are using more Adobe, not less. The product is sticky.
It really feels like a tale of two realities. The stock chart looks like a disaster, but the income statement looks like a fortress.
And remember, despite some selling, like from wealth enhancement, overall institutional ownership is still sitting at around 81%. The heavy hitters, the big money, are largely staying put. They're collecting that cash flow while the retail market panics.
So here is the final lowdown, the provocative thought to leave you with today. We have seen tech giants face this kind of crossroads before. Is Adobe the next Kodak, a company that invented the very technology, digital photography, that eventually made it obsolete?
Are they building the very AI tools that will eventually destroy their own subscription model?
Or are they the next Microsoft? Remember when everyone thought Microsoft was dead because of
Oh,
mobile?
yeah, they were a dinosaur.
And then they reinvented themselves for the cloud, and they became bigger, more dominant than ever. They successfully pivoted. They embraced the new wave. If Adobe is the next Microsoft, and you can buy it today at 17 times earnings, well, that's the treat of the decade.
But if they're Kodak, it's a value trap. It all comes down to execution in 2026.
And we will be here to track it. That's it for today's breakdown of Adobe. If you found this helpful, make sure you are subscribed. We have more breakdowns coming your way.
Thanks for listening. We'll catch you on the next one.